The Fed's increasing rates, which means mortgage rates are headed up, right? Well, not exactly. See, that's one of the common misunderstandings of the Fed funds rate in comparison to mortgage rates, is that the Fed impacts mortgage rates, and that's actually not the case. So that's the point of this video, is to clear up how the Fed funds rate works and how mortgage rates work. Let's get moving. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together we'll make it happen. Let me first of all explain what the Fed funds rate is. The federal funds rate is the interest rate at which depository institutions trade federal funds, which are balances held at Federal Reserve banks, with each other overnight. That means that when a depository institution has surplus balances in its reserve account, it lends it to other banks in need of larger balances. Simply, a bank with excess cash, which is often referred to as liquidity, will lend to another bank that needs to quickly raise liquidity. Okay, so what does all of that mean? Well, basically, the Fed funds rate impacts short-term lending rates, primarily those tied to the prime rate, which is directly related to the Fed funds rate. So debts related to the prime rate include credit cards and home equity lines of credit, but not long-term debts like mortgages. The Fed funds rate also impacts yields on savings accounts and CDs, short-term type assets as well. So when the Fed funds rate increases, what we will see is a higher interest rate on credit cards and shorter-term debt. What that causes in the economy is for people to spend less. Of course, the cost to buy things becomes more expensive when you're financing the cost of those goods. So that generally means that the economy will start to slow a bit when the Fed funds rate increases. Now, if the economy slows, in turn, what happens is the stock market starts to decrease. And that's just because the value of the companies that generate revenue and income from consumer spending, reduces, therefore reducing their profits and therefore reducing their share price for the stock market. When stock prices start to decline, we generally will see bond prices start to increase. Bonds are a more secure, less volatile asset to own in comparison to stocks, which is why they generally will react to each other inversely, meaning that when stocks go up, bonds go down and vice versa. And guess what? Mortgage rates are directly tied to the 10-year Treasury bonds, which means that generally when we see the stock market go down and bonds go up, so do mortgage interest rates. So let's kind of summarize this, right? So the Fed says that they're going to increase rates. That's going to reduce consumer spending, dropping stock prices, increasing bond prices, and therefore increasing mortgage interest rates. So to a degree, you can say that there is a relationship between the Fed increasing interest rates and mortgage interest rates going up as well. But here's the thing. Generally, the Fed will announce rate increases far ahead of when they will actually increase the interest rate. We're seeing that right now. We anticipate and believe that there will be a rate increase in March based on what the Fed has shared. And so what's happening right now is the market is already taking the corrections necessary based on that anticipated change in March. We've already seen stock prices start to decline. We've seen bond prices start to increase, and we've seen mortgage rates increase as well. So although they are related and they're based on similar information, such as economic data in terms of consumer spending and inflation and all of those factors that play into the overall economy, mortgage rates are not necessarily directly tied to the Fed funds rate. In fact, take a look at this chart. In this chart, I've plotted 3 lines. The 30-year fixed mortgage rate over 10 years, 10-year Treasury yield over that same time period, and the Fed funds rate as well. Now, if you were to look at these 3 lines, which one doesn't match up? Well, as you can see, it's the Fed funds rate. 30-year fixed rate mortgages are directly tied to the 10-year Treasury yield. The Fed funds rate, on the other hand, has no direct impact on 30-year fixed rate mortgages. You can even see that lag I was talking about, where mortgage interest rates and the 10-year Treasury yield go up before the Fed funds rate does. And that's because of the announcements that they make in anticipation of future rate increases. So the bottom line, the Fed funds rate is not a reliable source in forecasting where mortgage rates are going to go. Forecasting mortgage interest rates is similar to forecasting where the stock market will go. And my suggestion is to not worry about forecasting mortgage interest rates at all, and instead focus on the things you can control. Increasing your credit score, increasing your down payment, the things that are going to have a much larger impact on your ability to get a better interest rate in comparison to the uncontrollable factors that may occur in the market. Did I answer the question you came looking for? If not, leave your question in the comments below and I'll be sure to reply. And if you found the info helpful, I'd love a click on that like button. If you're serious about making your first home purchase, check out these other videos as you work towards buying a home. Or you can call or text me and I can help you directly.